The official rate of inflation continues to fall, and it is now in the lowest place that it has been since April of 2021. But alternative sources of measuring inflation are telling a wildly different story than what the official narrative is showing. So the question is, will inflation continue to fall, or is it going to bounce back with a vengeance? In order to answer this, we're going to look at a few examples that are similar to today throughout history, such as the 40s and the 70s. And what we're going to find is that while inflation will continue to move down in the short term, there's a high likelihood, almost a certainty, that it will roar back with a vengeance over the next decade or so. But first, a word from today's sponsor, Vaulted Silver. Did you know that most of the time silver is more expensive than gold? Obviously, I don't mean per ounce, but most of the time when you're buying silver, you're paying 20%, 30%, even up to 50% in premiums, markups, and commissions. But Vaulted Silver is changing the game. Vaulted Silver has managed to cut out 70% of the traditional supply chain for silver. This eliminates almost all premiums for buying physical silver, and it also increases security. With Vaulted Silver, investors always own designated serial numbered bars or specific sections of segregated bars. This is a different model than most services that offer pooled metal. Vaulted Silver investors can even move their holdings into smaller coins or bars at any time to take physical delivery. This groundbreaking pricing, paired with their rock-solid asset structure, is something no competitor can touch. They were able to do this because of a unique partnership with HSBC Bank. HSBC Bank is one of the 4 large institutions that is the core of the London bullion market, which is the largest and most liquid in the world. And the only reason Vaulted Silver was even able to form this relationship is because of some other projects the company has going on. Because usually HSBC vaulting services are reserved for the massive players like GLD and even like central banks. Clearly, Vaulted Silver is being launched on the back of an enormous amount of time, effort, and money, all put into making the top of the line, world-class silver storage product for you. As always, the Vaulted website and app are insanely easy to use and allow you to get started in literally just a couple of minutes. And the best part is they gave me a discount link to offer you that actually gives you free storage on your silver through the end of this year. So if you want to take advantage of that crazy deal, sign up for Vaulted Silver using the link in the description today. The inflation numbers recently came in for May and showed that the official measurement of inflation, the CPI, continued to move down. One thing you'll notice about this is that the Federal Reserve's preferred way to measure inflation when they look at the CPI is by excluding food and energy. This is called the core CPI. And you'll notice core CPI is usually far below the official CPI. But recently, core has been a lot more sticky, with core inflation coming in at 5.2% for May, whereas headline is down at 4.1%. Even with inflation at 4%, it is rare throughout recent decades where inflation is this high. A brief couple of years throughout the late 80s and early 90s where it was above 4%, and obviously in the early 80s and late 70s when it was above 4%. Despite this, many economists are looking at this as a good sign, saying at least we're headed in the right direction. But inflation is not equal everywhere for everybody. For instance, if we take a look at the cities that had the biggest drop in the pace of inflation, we can see it's all over the map. Keep in mind, this is a drop in the rate of inflation, not a drop in prices themselves. The difference between the two, I always give the example of a car. If you're in a car and you're moving forward, that's like prices themselves going up. You are increasing your distance, you are increasing the prices. If you want to measure how fast the prices are going up, that'd be the same as you measuring how fast your car is driving. You may be driving slower or faster, but you're still moving forward. Prices are still going up. Deflation would be like throwing things in reverse. You're actually lowering the distance. You're reducing prices. And we don't have that yet. While cities show different levels of inflation, we also see different levels of inflation depending on the items being bought. We can see that health insurance, gas, airline fares, truck truck and car rentals have actually seen deflation over the last year, meaning those prices over the last year have dropped. Maybe they're not as low as they used to be, but they've still dropped over the last year, the actual prices, versus things like motor vehicle repair, vehicle insurance, pet food, and frozen fruits and vegetables are still increasing in price at a very rapid pace. This is another indicator that shows that there really is no one measure that can accurately capture what the true inflation rate is, because it's actually different for everybody. As we can see here, baby food and formula are up a little over 10% in the past year, whereas other food items are up 6 to 8%. This obviously means for anybody who's buying baby formula, you're gonna be hit a little bit harder than the rest of the food items. This is just one of the problems leading to the inaccuracy in trying to measure inflation, and there are other sources of measuring inflation that try and give a much more accurate reading. One of these sources is called Shadow Stats, which compares the current rate of inflation versus the way they used to measure inflation in the 1980s. But it is also true that purchasing habits have changed dramatically since the 1980s. So that's not an accurate comparison to say, hey, if we still measured it in the exact same way, well, then we would be mismeasuring it, which is why it comes in at roughly 13%. Shadow Stats also shows the 1990 based measurement of inflation, which would be coming in at around 9% right now. But again, in the last 33 years, there have still been significant changes to what and how people spend money, which means that this is likely a little bit higher than what it really is as well. The third alternative source of measuring inflation comes from Trueflation.com. Trueflation.com right now is showing the annual inflation rate at only 2.74%. Now, just in case you think that this is a measurement that's always going to understate, that's actually not true. At the peak of inflation in June of 22, the CPI came in at a reading of 9.1%. At that exact same time, Trueflation was showing almost 12%. And so at the peak of inflation, while the official measurement was likely understating what the real inflation number was, it's very possible that right now, the official inflation reading is drastically overstating what the real inflation rate is. Either way though, if we take a look at some leading economic indicators, it looks like we are looking over a cliff, that prices are headed downwards from here. Regardless of what the actual rate is, it does look like prices are heading down steeply and soon. One of these leading indicators is the shipments of empty US cardboard boxes. Cardboard boxes are used in every step of the supply chain, which makes it a good leading indicator of the economy. And you can see every single March is usually a peak. And from last March to March of 2023, sales were 11% lower and showing a steep decline in the trend. However, much of this decline is very likely to be short-lived because the structural problems that are causing the inflation are still baked into the cake, and it doesn't look like they are going to be solved anytime soon. The reason why they're not likely to be solved anytime soon is because it's very possible policymakers are using the wrong playbook to address the current inflation. We're going to take a look at the 40s and the 70s to see why. As Lynn Alden points out, during the 1940s, the inflation was caused by monetized fiscal spending on the war. Basically, the government borrowed a bunch of money to spend it on the war effort, and all of that borrowing was monetized by the Federal Reserve. This meant that during the 1940s, the Federal Reserve could continue to keep interest rates low, and eventually inflation came back down. This is because after the war, the deficits came back down, and the government stopped borrowing and spending so much money. If they had tried to raise interest rates to stop inflation during the 40s, government deficits would have just gotten bigger because they would have to borrow more money to pay the extra interest rate on all that extra spending. They wouldn't have just spent less. And in the 70s, when the Fed raised interest rates to fight inflation, they were doing so when the federal debt to GDP ratio was extremely low. That meant you weren't putting more stress on the government by raising interest rates because they really didn't have that much debt relative to the size of the economy. The government could afford those extra interest rates no problem. And so today we've got like a Frankenstein mixture of those two problems, the one from the 40s of the high deficit spending, the one from the 70s advantages of the high interest rates. The problem is we don't have the advantages of either of those time frames. In the 40s, they stopped the spending once the war was done, and in the 70s, they had a very low federal debt to GDP ratio. And here's where we get to the real structural problem. Today, the debt to GDP ratio is well over 100%, and the federal deficit is getting massively worse on average every year. Meanwhile, the Fed is raising interest rates to try and squash inflation, which is really just making government spending go up in order to afford all those higher interest rates on all that extra borrowing they're doing. And even if rates drop significantly from here, they've already done a ton of borrowing at the extra high interest rates. And on top of that, the obligations that they have to continue increasing their spending from mandatory spending like Medicare and Social Security over the next 1 to 2 decades will blow up the budget. This means we're not going to get a replay of the 40s where the government will just reduce spending. They're going to keep on spending more and more, and to the extent interest rates stay high, it will accelerate how much they have to continue spending. This means we're forced into one of two outcomes here. We will get to a point, a fork in the road, where the federal government can no longer afford the interest on its debt. At that point, we'll be forced into extreme austerity and they'll reduce the budget or they'll just default. Either one of those is extremely deflationary as prices will crash as a result. The possibility of our federal government choosing austerity or default in that case, it's almost zero. Instead, they'll use the central bank, the Federal Reserve, to monetize the extra spending, meaning they'll borrow from the money printer instead of from the economy. And if the Fed at that point says, hey, we're not going to lower rates to help out the government, well, then Congress will probably rewrite the Federal Reserve Act. They'll absorb the Federal Reserve underneath the Treasury, give it a new mandate, which is basically to finance government spending. This is what most nations have done when they get to this point. Central banks lose their independence and become a tool of the central government instead. And once that happens, the extra spending continues and becomes outright inflationary. In conclusion, right now we have many forces at play that look like they're pushing prices down, and that will continue for a short amount of time. But the structural issues of the federal government's high debt to GDP paired with its growing deficits and high interest rates in order to try and stop the current inflation will actually lead into embedded inflation for the next decade or so. And finally, if you'd like to learn advanced investing strategies so that you can prepare for these coming financial storms, check out my training library at Heresy Financial University, linked in the description below. As always, thanks so much for watching. Have a great day.